Hello, everyone. In today's episode, you're going to learn about three things. So the central banking narrative, China, and purchasing manager indices. Now, before you move your mouse to that cat video that looks so much more interesting, remember this show is about helping you, workers, investors, savers, better understand how the creation and destruction of money on a wholesale level affects your finances, your economy, our politics, our society. My name is Emil Kalinowski, and I'm joined by Jeff Snyder, the head of global research for Alhambra Investments, a man that's dedicated his professional career to understanding the piping and the flows of our global monetary order. In fact, it's a level of interest in plumbing we haven't seen since the Losers Club entered the sewers of Derry, Maine, which some of you may have recently seen a two-part documentary about called It. Jeff, good morning.
Good morning, Emil, and I think it's great that we started our episode here in the sewers with all the real pipes and the real stuff that flows through them.
We're going to find things that smell. Hopefully we don't find anything horrifying. The Losers Club went into the piping system, the sewers. Not all of them made it out. Let's see what happens. Let's turn to China first. 4th of August, you wrote something at the Alhambra Investments blog post, that you haven't written about recently, and that is China. And the title was called, quote, "What's in the Same Number? China's Part in the Eurodollar Story." What told you that it was time to write about the Chinese yuan?
Well, a big topic of conversation, certainly across the financial internet and financial media, is, of course, the dollar and its supposed crashing, and Jay Powell's ruining the global reserve currency, and he's going to print the dollar into print infinity, and that's going to destroy the U.S. dollar as a reserve currency. And everybody else who's been waiting for this moment has been pouncing all over it. And I've been writing recently about some of the other currencies involved in the story, which are much more than just the euro, as we talked about last time. You know, DXY being moved by the euro and other things. But the real big one out there is the Chinese currency. And so I thought it was time, in this dollar story, this larger dollar story, how do the Chinese actually fit into the story? Not just how it's being told of, the Chinese are trying to ditch the dollar, their bilateral currency swaps and other kinds of arrangements that have cropped up all across the last decade that, we're still here dealing with the dollar problem.
That's great. We're going to touch on all that. And I want to start with your great ability. For people that don't read your work, they may not notice this, but if you study your work regularly, you'll notice that you have an ability to identify artificiality in economic accounts. And it kind of reminds me of a line from Prometheus, which was a promising science fiction story by Ridley Scott. And our intrepid explorers arrived at a planet. It looks deserted. And as they're flying around the planet, someone notices a straight line. And they say that God doesn't do straight lines. And nature doesn't do it either, at least not in very large segments. And it's because it's a complex system. Another complex system is that interaction between the Chinese economy and the greater Eurodollar world. You saw a straight line and you said, nah, this is not right.
Yeah, you're absolutely right, because, in any kind of messy, complex, market-type environment, you're never going to see things that are exactly equal unless there's a purpose there. It's engineered. There's somebody has done something that has created a result that was intended ahead of time. If it's just a messy marketplace, especially, we're talking about the Chinese economy, massive flows of currency, massive flows of goods and service. I mean, incredibly, unbelievably complex. And at the center of all that, you have the monetary system. And at the center of the monetary system, you have the People's Bank of China. So if we're starting to see, or if we actually see persistently a straight line, as you identified in the movie, it's a very clear signal of artificiality. Somebody's doing something. And they're creating a result that they want to create. And therefore, you have to look at that and say, why are they intending to create this result? What does this relate to? What is the straight line pointing toward? and what are the implications in the wider story that we're trying to piece together?
So let's identify what was that exact straight line between two data points, two reporting periods. The movement was?
It's on the People's Bank of China's balance sheet, on the asset side. The vast majority of the central bank's assets are what they call foreign assets, which are, U.S. treasuries and all those types of, foreign reserves, that other denominations of foreign reserves that central banks run across through their daily normal activities. And normally what happens is that under, ideal conditions where the global economy is growing, the Eurodollar system is adding and contributing US dollars to the global economy, more and more of those end up in the People's Bank of China's hands, which allows them, because it's on the asset side of the balance sheet, allows the central bank to create RMB, or internal money, mostly in the form of bank reserves, but also in the form of physical currency that they print. As the assets go up, so does the liabilities and money go up. Since 2011, and really since 2014, however, as we know, we talk about this all the time, the Eurodollar system has experienced this contraction, these spasms that have taken dollars outside of China's hand, and the Chinese officials have tried various ways to offset or ameliorate this dollar deficit that they've been faced with for more than half a decade now. And one of the ways they did that, especially in 2015, was to sell off those foreign reserves, sell off those reserve assets on the People's Bank of China's balance sheet. So the assets that the central bank actually held. Think about quantitative tightening on steroids. That's exactly what the Chinese opted to do back in 2015 during the third Eurodollar squeeze, what we call Eurodollar 3. And so the asset side shrank, which meant that the liability or money side had to shrink too. And so the two things were related. You had foreign reserves that were shrinking, therefore bank reserves in RMB internally in China also had to shrink as a consequence. In this fourth Eurodollar episode that began back in 2018, the Chinese have decided, for whatever reasons, we'll probably never know the specific reasons, we're not privy to those kinds of conversations, and the Chinese communists are not very big on transparency. So we'll never know exactly what or why, but they've handled this fourth outbreak very differently than they did the third one. Instead of outright selling in mass, trying to make up this dollar shortfall, mobilizing their reserves, they've decided to do something else. I don't know what else it is, because I can't find it. I've looked everywhere for it. They've been very good about hiding their big, massive footprints. But what we do see is that the level of foreign reserves on the Chinese People's Bank of China's balance sheet has been almost exactly the same for month after month after month, as if they're pegging the level of foreign reserves. And then, of course, as I wrote about in this most recent article, for the month of June, it was almost exactly the same number as it was in the month of May. So what that tells us is essentially they're doing stuff that we don't know what they're doing. And if they're doing stuff, there must be reasons why they're doing them.
And just to give people some scale, I believe the normal number, let's say, I think it was 21 trillion yuan, right? And then 21 trillion 700 something. And then the next month they reported 21 trillion 700, and then the difference was 70 million yuan, which, if you can't translate that into dollars, I've got that in my kitchen drawer here. And so your point is
21 trillion 833.26 billion. That was the month of June, and the month before it was 21 trillion 833.33 billion. So the difference was, as you pointed out, 70 million, which is infinitesimally small.
Well, what is the percentage? You actually calculated. What's that percentage change?
The percentage change was 0.0003%. So 0.0003%, which is, again, it was a rounding error.
And you say that that chance of that happening, assuming no artificiality, no manipulation, is random, pure. I mean, just impossible, right? It's got to be. The probabilities favor that there's manipulation taking place. Why? Why is my question?
Right. There's no other way that you can have a complex random marketplace end up in the same number 2 months in a row. And it's, again, the larger point is it's not just 2 months in a row either. This is not just an outlier that happened. We've been following the straight line. It's been a little bit less straight in the months before, but it's clear that the Chinese have been embarking on this course of action for more than a year already. It's just gotten so ridiculous to the point where it seems like they're actually pegging the level of foreign reserves on the People's Bank of China asset side of its balance sheet.
You were discussing history, and perhaps it would be good to do just a little bit of a review, just for people to understand what has been taking place over the last 20 years in China. So let's start with the early 2000s in the world and China. What was happening when it came to money creation and the PBOC?
It's actually pretty simple. When the dollar system, as I mentioned before, was working the way it was intended to work, which meant flooding the world with dollars. I mean, a literal flood of dollars, not this monetary policy Jay Powell crap that we keep hearing about. When the Eurodollar system was actually expanding and expanding rapidly in the middle 2000s, that meant a lot of dollars found their way into the Chinese hands because U.S. investors or foreign investors used U.S. dollars as a way to intermediate investing in what was at the time the biggest, fastest growing, most stable growth economy that there was in emerging markets. So, as the People's Bank of China had pegged their currency prior to that, that meant that the central bank was very active in currency markets. As those Eurodollars hit their shores, a lot of them ended up in the hands of the central bank, who then converted them essentially into internal RMB, mostly in the form of bank reserves. And because so many dollars were flooding into the central bank, they had an inflationary problem. There's too much money being created, which then led to not just the People's Bank of China, but also other regulators to try to restrict the level of bank lending and monetary growth through the banking system, which meant that they raised the reserve requirements on banks almost in tandem with the rise in the Chinese currency.
But then I don't think they were very successful because the money creation continued and inflation was taking place. It was almost unstoppable. What about 2007 to 2009? Was China affected by that shock?
Yeah, the first Eurodollar shortage, the first global dollar shortage back, we call the global financial crisis, first global financial crisis, they were affected by it as everybody around the world was, but certainly not to the same degree that they were later on. So for the Chinese, it was sort of a temporary speed bump on the road to what everybody thought was an indestructible growth model. That the Chinese can simply grow as fast and as far as they want. In fact, they've been doing this for 25 years because that's what they realized, that to survive in the modern world, to learn the lessons that the Soviet Russians didn't, they had to continue grow, and prioritize economic advance over everything else. So in 2007 to 2009, it was a temporary speed bump where they made adjustments. They went back to pegging the currency for a while, which meant they were supplying dollars into the local marketplace, level of reserves, all that stuff. But by and large, 2008 and 2009 for them was not as big a deal as it was everywhere else.
And in fact, that led to a lot of talk about decoupling, about the end of the Washington Consensus, that the 21st century would be the Chinese century, because looking around Europe and the United States, it looked like a disaster zone. But in China, they just had the Olympics. Their economy rebounded right away. It looked like they knew what they were doing and that they were home free, that the emerging markets had finally decoupled from the advanced economy money centers. At least China did. What happened in 2011 and 12, the second crisis?
Well, the simple version is that we found out that wasn't true, right? Well, the dollar system, between 2009 and 2010 and 2011, there was only ever a partial recovery. Most of that recovery, as you just pointed out, Emil, was focused on emerging markets. The idea persisted that, okay, I think it was Mohammed Al-Arian from PIMCO called it the new normal would be the growth model going forward for the developed world, but the emerging market world would continue to go on and continue to grow as it had for practically 20, 30 years beforehand, especially China because the government prioritized growth. They would do everything they could to make sure the economy stayed on track. And so for a couple of years, that seemed to be the case. But after we got into the second dollar shortage in 2011, things started to change. It started to radically change, such that even the Chinese economy began to slow down in a way that looked a lot like what had happened the rest of the world a couple years beforehand. And slowly it began to dawn on people, especially dollar providers and dollar redistributors in Japan, that, oh my God, maybe the Chinese are not invulnerable, and that this global dollar problem that we're having, which is becoming a global economic growth problem, will impact everybody. If not all at once, then at least nobody's immune from it, and everybody's going to have to deal with it at some point, going to come face to face with the consequences of what is really a very different situation.
Now, for people who are who need a visual example of this, China was continuing along at a 45-degree angle, I would say, after 2008. The 2011-12 crisis didn't knock them off. Well, it did knock them off course, but not down. All of a sudden, now they were just growing less quickly. So it wasn't a full-blown panic, but 2014 to 2016, the third Eurodollar crisis, that epicenter was in emerging markets, most famously in China. And that one, well, I'll let you tell the story, Jeff. What happened to China in those 2 years?
Well, those are the 2 years where everybody started to talk about China having a hard landing. Because really at that point, it wasn't just slowing or rate of growth, a small change in the second derivative. It was really like, okay, maybe the Chinese growth story has actually changed here. And we've talked about this before, and we'll talk about it, I'm sure, a lot of times, which this is what happened in 2015, especially 2016, led Chinese authorities at the 19th Party Congress in October of 2017 to completely rewrite the priorities. China was no longer going to prioritize growth because of their experience in 2015 and 2016. They realized this is it. We've gotten as much growth as we can possibly get, so we're going to start changing the way we do things in China. And this was 2017. And a lot of that, we saw the same kind of corroborative evidence and corroborative impacts in the way the dollar system treated the Chinese and the way the Chinese currency behaved, and as well as how the Chinese central bank reacted to those currency changes in terms of how it balanced its own balance sheet and the money flows on it.
That experience, the third crisis, was when we saw the Chinese yuan it inflected. It started going the other way. It had been appreciating for years. And ever since then, it's been going down. But as you point out, you've been studying it so well, and there's this whole Hong Kong connection that we could talk about in another episode. The currency started to go down, but the PBOC was fighting tooth and nail, coming up with different plans on trying to stop to arrest that fall. And one of them that is very popular in the Twitter sphere is the Chinese Petro-yuan, and that's a question that we often get. Can you talk a little bit about whether the Chinese Petro-yuan, whereby the purchase of oil would be denominated in yuan versus dollars, is as important as perhaps the U.S. agreement in the 1970s was? Or was it something else less important?
Well, I think let's start with there's a couple points here, and let's start with the first point, which is, as you just pointed out, I think really well, Emil, that what we're really looking at is the correlation between Chinese authorities fighting, doing stuff, having to fight this big dollar problem, and how that correlates to the falling CNY, which is, of course, the other side of that is a rising dollar. So that's our major point here, what we're going back to, the Chinese People's Bank of China balance sheet. By recognizing that straight line, what we're recognizing is the Chinese are fighting. They're doing something. They're trying to counteract forces that are beyond their control, and those forces are CNY negative or dollar positive. So that's what we're really looking at, is the more the Chinese have to fight, and more the Chinese feel they themselves have to do this fighting, these undertake these measures. That tells us something about what's going on in the dollar system. It tells us that the dollar system is still malfunctioning. And one of the ways that they've attempted to deal with their dollar deficit, this involuntary dollar deficit, is they've tried all sorts of ways to diminish or reduce their reliance on U.S. dollars because it's so hard for them to get them. And as you pointed out, the Petro-yuan was one of the ways that that the Chinese authorities came up with to say, look, we need a lot of dollars because we need a lot of oil. And if we don't need to price all of our oil in dollars, we can start pricing them in yuan and use RMB currency instead of dollars. That will lessen our dollar need. It will lessen our dollar load and reduce this deficit and reduce the problems that come along with that deficit. What ended up happening, of course, is, I mean, that's a perfectly legitimate strategy and something that you would expect Chinese authorities to undertake in those situations. But what happens time and again as they do these things, including these bilateral currency swaps that the Chinese try to adopt here and there, is they get overhyped into these massive, oh my God, this is it. The Chinese are going to take over the global currency. When it's not really what's happening. This, again, our major premise, the Chinese are essentially, they have a dollar problem and they're doing their best to try to mitigate it, including, if they can, pricing some of their imported oil in their own currency. It's not an attempt, it's not an attempt to replace the US dollar's reserve currency. It's actually a way to try to diminish the disastrous impacts of being stuck with the dollar.
Jeff, I started the episode by talking about how the creation and destruction of money will affect our economy. And I think this is the last graph of this article. I'm going to pull it up for the YouTube folks so they can see it. But the last graph, if you can just talk to a little bit about how you show two of China's big three economic accounts. You show retail sales and which one else? Do you show industrial production?
Industrial production, yeah.
And then you compare it to bank reserves or the PBOC's liability to the internal banking system. Just talk a little bit about that.
Well, it's the real economy consequences of what is this dollar squeeze or dollar shortage, however you want to characterize it. The malfunctioning Eurodollar system that goes back to 2007. So, I mean, the very good correlation between what's going on, of course, internally and externally on the People's Bank of China's balance sheet. Dollars flow in, that means more RMB in bank reserves, so higher growth in bank reserves, higher internal monetary growth inside of China. Dollar problems show up 2008. They're temporary, but we get some growth back, some recovery in 2009, 2010, which, as you can see in the chart, allows the Chinese economy to bounce back very quickly from the Great Recession in 2008, 2009. However, by 2011, we have this really paradigm shift, this change in the dollar system where nobody is safe from it. And all of a sudden you have external drag of dollars, internal drag of RMB in terms of not just bank reserves, but also physical currency printed. Because if you're constrained on the asset side, you're constrained on all of the liabilities. And all of a sudden, as monetary growth becomes constrained, so does economic growth. And it's not just China. It's not just that the Chinese economies experience the same thing. We find these same correlations all throughout, not just emerging markets either, but all throughout global economies. It's the global dollar system that's causing all of these internal monetary constrictions, which are then reinforced in these economic slowdowns and downturns and even outright recessions, and in some places, depressions that these economies have never recovered from.
Jeff, if our audience is interested in learning more about China, we had a big episode about China. And so they can go to Apple Podcasts or Google Podcasts or Spotify, Stitcher, all the different podcast providers, and they can download that and they can hear what we were talking about. I believe it was episode 15. Okay?